Good morning, everyone. Welcome to the webinar today. I'm Suzanne Faulkner. I'm with Xact Accounting, and I've got Dan Wilkinson here today with me, also from Xact Accounting, and Kurt, of course. I'll be speaking first and running through some topics around property and so forth, and then Dan's going to come on and do a section, and Kurt will follow us up towards the later part of the webinar. So we might just kick off if everyone's ready to get going and get stuck into it. So my main presentation today is just looking at property, talking about what we are looking at in terms of different aspects of property, owning property, and renovating, flipping, buying, selling, those sorts of things. And we know a lot of you are sort of getting stuck into property these days, and so we wanted to touch on some of the tax tips and traps for those sorts of activities. So what are the key things we need to be looking at? There are a lot of issues to cover when we look at these sorts of things. We are going to have a bit of a Queensland focus today. Having said that, the general tax rules do apply across Australia-wide. So if you are from other states, a lot of this will apply to you. But there are some specific state-based things that I'll touch on very briefly that are very Queensland focused. Purpose and intention is a really big thing when we're looking at property and what we're doing with property. What I mean by that is when you're looking at a property to buy, what is the reason that you're looking for it? Is your reason to buy, hold, rent, long term, and then potentially sell it, in 10 or 15 years? If that's your intention, then you're looking at it for investment purposes only. If your intention, though, is to buy the property, perhaps you found a block that could suit two houses on there. It's currently got one, so you're going to knock it down. You're going to split the block. You're going to put two houses on it. What you're looking at there in terms of intention is much more broad, and you're touching then on property development activities, and that's the key thing we want to sort of talk about today. What we think, though, is not necessarily enough. We've got to actually have the evidence to support why we are thinking that or what our intention is. And what I mean by that is, have you got a proper plan in place for what you want to do with that property? So if you are thinking of splitting, renovating, developing a lot in some sort of fashion, what have you done to actually show that that's your intention on that block? Have you got some numbers, a spreadsheet that you've put together that shows what income you expect to generate from that block, what the costs are that you expect to incur, all those sorts of things that go behind it? What have you actually done in terms of activities like that before? Is this the first time you're embarking on something like this, or is this the second, third, fourth, 10th time? So those sorts of things can help to support what your intention is when you're looking at a property that you want to purchase and develop. So they're key things, because then I'll come back to those in a little moment in terms of how that can be relevant and what that means when you're looking at property. I want to touch on structure very briefly, and this is something a lot of people don't give much thought to. Often what we find with clients is they'll go out on the weekend, have a look at a few places and go, that's the one, I want to buy it, and they go straight to contract, not thinking about what does this mean from a tax perspective and under structure. And so often that'll be, I just sign off the contract in my name. What does that mean for me? And I'll do some examples in a minute, but effectively what that means is you own the property in your name. So it's mixed up then with all your other personal assets. So you might think, okay, I want to keep that separate. I don't want to mix these kind of assets with other assets in my name. Fair enough. Let's put it in my partner's name. That also can be fraught with danger. Same thing happens there. You're mixing assets. So you get a sort of a cross-tainting of asset pools when you do that. The other thing you've got to consider, if it's in your name or your partner's name, is the tax implications at the end of the day. Because any income you generate from those projects will be assessed to you personally or to your partner personally. Joint names, the same thing happens. It falls back to both of you jointly. What if you use a company instead? This can be a really good option. If you are intending it for income generating purposes only, so a flipper, for example, or a splitter, those sorts of things could potentially be good in a company. What is restricted though with a company, you've got separation of assets, that's great. You've got a separate taxing environment, which is great, but it means that you are going to pay 25% on any tax or any taxable income that you generate off that investment and in that company. A trust is generally a better structure you could look at using, because it gives you flexibility in working out how you want that income to be taxed. So these things can be quite complex, and it's very important to have a chat with your accountant or have a chat with a good accountant that knows these things to actually get you in the right direction and in the right space for this. The other question around structure, can I use an existing structure, something I've already got set up, or should I always set up something new? Now that's going to very much depend on your personal circumstances. When we say something that's existing, we'd prefer to look at that as something that's not being used, although you might have set it up a while ago. If you've got other assets or a business or something in that structure already, we would strongly recommend not using that for a small venture or small activity in terms of property development. So there's a lot of factors to take into account when you're looking at structure. And as I touched on before, income versus capital, this is a definition that has come through the law over a long period of time. There's been a lot of cases looking at these kind of, when I say cases that have actually gone through the court system, looking at whether an activity or a development was in an income space or in a capital space. And I know the question that often people ask is, why does it matter? From a tax perspective, it matters hugely. If it's income, you do not get the benefit of, and most of you would be aware of, the 50% discount that you get if it's a capital asset. So when you buy shares and you hold them for 10 years and then you sell them, you get the benefit of the 50% discount on capital gains tax. Same thing applies with property. If that property is for capital generating purposes rather than income producing purposes. And there's a lot of discussion that's happened in the courts. The ATO has got a lot of rulings around this about whether it is or whether it does fall under a definition of income or does fall under a definition of capital. So there's a lot that goes into that, and we'll talk a little bit more about that today, but we've got a lot to cover, so we can't go into a lot of detail around these things, but you can certainly reach out if you've got questions around these sorts of things as well. Income and capital, as I said, you've got the benefit of a 50% discount if it's capital. If it's income, it all gets assessed. So that's where a company structure, it's probably not going to matter too much. Your tax rates are going to be the same. Companies don't get access to the 50% discount. A trust could potentially be beneficial. Personal names, that's where it can really make a big difference. So that's why it's important to know and understand the distinction between, is what I'm doing income in nature or is what I'm doing a capital asset, and therefore a long-term proposition. Example here, just in terms of the numbers, I've got Joe here, he's buying a property for $750,000. He's going to spend about $250,000 on renovations, and then he's going to sell the property for $1.1 million. So we've got total cost, $750 plus $250 of $1 million, sale of $1.1 is going to leave us with a gain on that property of $100,000. Now, if he's also generating wages of $180,000 from his business or from other sources of income, salary or whatever it is, he's now going to add those two together. So his wages of 180 and his taxable, his gain on the property of 100, he's going to have total taxable income of 280,000. Now the additional 100,000 will generate a minimum of 47,000 in tax if it's all on income account. So that means that the whole property is accessible. We've treated it like a flipper, a small development activity, therefore it's all accessible. He's actually going to lose half of his gain in tax. So this is where income and capital can be quite important to work through. If, on the other hand, we looked at this as a capital venture, so he's looking at keeping the property for a long term, he's done some renovations, yes, but the intention is to retain the property for 10 years and then potentially sell it. In that instance, he'll be entitled to the 50% discount. So when he does sell, he's only going to be assessable on 50,000, not the 100,000 we originally had. So that means he's only going to pay tax of about 23,000. So only less than 25% of his gain is actually going to be assessed as tax. So you can see there's quite a difference in terms of the tax positions if you're looking at it from an income versus capital perspective. But in some cases, we don't always get the choice. So when we're looking at things like, what are we doing to the property? Often we'll buy something, it needs a bit of work, it needs renovating. We're asking the two questions. Firstly, what's our intention here? Is our intention to just fix it up a little bit and then rent it? Or is our intention to do a full reno? And when I say full reno, we'll come to that in a minute, and then sell it for profit. Now, why does it matter? Very much like what we've done in the income and capital example, if it's a repair, and when I say repair, we're talking about things like the door handle's broken, so we're just fixing the door handle, or the light bulbs have busted, we're just replacing a few of those. They're what we call repairs. If it becomes more significant and it's more like a renovation, so we're actually gutting the whole kitchen and putting a full new kitchen in, or we're gutting out the bathroom and replacing everything in there, including the bath, pulling out the sinks, replacing all of that, that's more of a renovation. When it becomes a renovation, those costs are not immediately deductible to us in the same way a repair is. those costs become capital costs on the property, and we have to either depreciate them if it's a rental property, or capitalize it, which means it gets added to the cost of the property if it's a potentially more of a capital asset and long-term issue. Now, where we run into a little bit of strife is if we buy a property, we renovate it, and it becomes what's called a significant renovation. And this is something that the ATO has sort of introduced as a way of trying to show us what's really a repair and what's really a regutting of the whole house, essentially. So a significant renovation effectively touches the majority of the house. So it might be something that happens to every part of the house, in all rooms. Repainting the house is not enough. But if we're talking about knocking down walls, if we're talking about opening up rooms, if we're talking about gutting the kitchen, gutting the bathroom, moving walls around, even adding patios, those sorts of things, you're likely to find it's more of a significant renovation. And that's where things can change again, particularly in the GST space. And I don't want to touch too much on GST today because it is quite complex and there's quite a lot of factors that go into play when we're looking at those things. But it's important to understand the difference between a repair, which is immediately deductible, and a renovation, and what happens then if it becomes a significant renovation. All key things that we need to factor in when we're looking at property and what we're doing with the property. Now, as I said, I don't want to touch too much on GST, but there's a couple of key things to understand. If it's residential property, generally we know there's no GST, but there are some instances where that might apply. So for example, let's take this scenario. We buy a house, it's on a nice big block. We know that we could potentially split the block, but instead we're going to keep it. What we're going to do, we're going to keep the house that's there. We're going to maybe move it forward on the block, and we're going to have the back of the block separated, and we might just sell that piece of land. Somebody else can do what they want with that bit. But the front, we're actually just going to renovate that property, and then we're going to rent it. So in that instance, renovating that property, we're moving it forward. It might be a lovely old Queenslander, needs re-stumping or even lifting. We're going to put a nice big area underneath. Upstairs, we're going to pretty much re-gut the whole place, move out a few walls, give some nice big verandas in there, all that kind of thing that would make it look just like a palatial, lovely old Queenslander. In that case, it's more than likely going to be a significant renovation. Under the GST rules, it then becomes what's called new residential. Now, it's important to understand that, because if it becomes new residential and your intention is to sell it, that entire project now becomes subject to GST. So where originally you would have no GST because it's a residential property and what's called input tax, it now actually falls under the GST regime, and we're suddenly up for GST on the sale of the property. But we can claim GST on any of the renovation costs and the purchase costs, etc., that have gone into the property as well. So you do get both sides of the story. So that's where I say it can get quite complex when we're looking at GST and the GST aspects of things. So it's very important to have a great accountant on board that can help you understand whether your project is going to fall under these rules or not, and also the tax implications of doing the same. Now, the question I get asked frequently, what if it's my main residence? And my answer to that is it depends. So we all know main residence exempt from capital gains tax. That's simple. So I buy the house, I live in it for 10 years. I might do some renovations and so forth. That's fine. No issue whatsoever. I live in it and then I sell it free of capital gains tax. But I know you guys, and a lot of you like to kind of test the waters a little bit, push the boundaries a little bit. And sometimes what we'll play with, and I know a few people that have done this, is we'll say, okay, I'm going to buy a house. We're going to live in it for a couple of years, renovate it, then we're going to sell it. Then we're going to go and buy another house, live in that for a couple of years, renovate and sell. That is what we call flipping. If you're in the business of doing that, you just constantly turn over properties in that manner, you are actually potentially going to find yourself outside of the main residence rules and into the space of income tax. The ATO doesn't like us doing this on a frequent basis. They see it as we're getting a windfall gain on something that is supposed to be intended to somewhere we live for 10 years or 15 or 20 years. So it is important to know if you are doing those sorts of things every couple of years, flipping, you could have a potential issue with the tax office down the track. And I know the question is going to be asked, how would the ATO even know? It's a very good question. Sometimes they don't, sometimes they're not going to pick up on it. But these days, all property sale transactions are reported to the ATO. The government departments are talking, so it does come through to their records, and they do note it on your pre-filled tax information. So that's information that your accountant or even you can now access via online services that tells you this is what the ATO already knows about. Now, if they start seeing that you're selling properties every 2 or 3 years, or even shorter, 12 months to 18 months, they are eventually going to start picking up on that and saying, should there be actually a taxing point at some point on one of these? So just be careful if you are looking at flipping on how you're doing it and when you might potentially be moving into more of the business of flipping rather than it being a true main residence renovation and sell. What else do I need to know? Really good question. Land tax, I know, a dirty word for many, many people. And as I said, this is where the Queensland-based rules kick in. Land tax does apply in a lot of states. Northern Territory does not have land tax from memory, but a lot of the other states do. It is different in every state, and the thresholds are different and the rates are different in every state. In Queensland, there is an exemption for your main residence and the first $600,000 of property that you own aside from your main residence, if it's in your own name. If you hold that property instead in a structure like a trust or a company, the threshold's reduced to $350,000. So just be wary of that. It's assessed on all property owned by that entity. So I know some people will actually set up separate trusts for each property to try and minimise their land tax obligations. That's something, again, to discuss with your advisor and to have a look at in terms of what might work best for you or otherwise. The other thing to note, different states do have some different concessions when it comes to structures. Victoria, for example, has some quite nice concessions when it comes to trusts and property. Queensland doesn't, unfortunately. They were even just about to introduce some new changes to some of the laws here in Queensland around land tax and trusts. Thankfully, that's gone now, but that is important to know that some states will have slightly different concessions when it comes to structures. So it is important to get an advisor on board when you are going through this. Good tip to note, if you are looking to have a chat with an accountant about what you want to do, it's always best to do that before you sign a contract, just to make sure you've got the right entity name on the contract when you get to that point. A couple other very quick specific Queensland-based things, QBCC. So for those of you that are builders in the room today and you are dealing with QBCC in Queensland, you probably are aware that QBCC has been tightening their rules in recent years and things are getting much more difficult in terms of meeting your license obligations. Structure is key here. Structure is really important. A lot of accountants are still setting builders up in trusts. QBCC does not like trusts, they don't acknowledge them, and they won't recognise assets held in trusts. So it means that you're going to end up potentially with personal assets on the line when it comes to QBCC licensing. Have a chat with a really good accountant that knows building and construction, and they'll be able to point you in the right direction in that space as well, or help correct if it perhaps is not in the right structure already. Minimum financial requirements and reporting, a couple of new changes there. Anyone in Queensland that's running at a Cat 1 or above or needs to lodge a minimum financial requirements report will now be subject to what's called general purpose financial reports. So the reports that your accountant already produces for you are what's called special purpose financial reports. Generally, general purpose reports have been reserved for the big end of town, those that required auditing or the big large companies that have to report to ASIC. Now we are going to be caught by this in terms of smaller businesses that are Cat 1s and above or lodging minimum financial requirement reports, in that the legislation changed. This isn't under QBCC regulation, this is a legislative change that QBCC are bound by that says we now have to produce general purpose financial reports when lodging an MFR. So if that's something your accountant doesn't know how to do, you might find yourself having to go to quite a bit of expense to get that sorted out. Often auditors are the only ones that know that, or big end accountants. We'll be happy to have a chat with anyone around those sorts of things as well. We do a lot of these, we see them almost daily in terms of issues and projects that people are trying to work on, or QBCC license issues that they're trying to fix. So a couple of key takeaways. It's never as simple as it seems. We look at the property, we see it and we go, great, I know what I can do with that, I know exactly how it's going to work, but the tax side of it is quite complex often. So be aware of that. Tax does make everything more complex, and have a chat with your accountant. Make sure they can do this stuff because it is complicated. We, as I said, would be happy to have a chat with anyone that has any queries around this. We're happy to set up a separate Zoom conference for anyone that wants more specific personal information as well. Happy to take questions. I think Kurt was going to have a chat now if there's any questions in the chat around anything that I've talked about this morning. But yeah, I'll hand it over to Kurt.
Hey Suzanne, I just want to say fantastic, man. I was taking notes while you were talking, and I've got I don't have any specific questions. I don't want to take up question time, but guys, please type in the chat box or the question box if you've got any questions. Please do that now, because we've got a big agenda, tight schedule. So we're going to hand over to Dan in a sec. If you don't have any questions, I mean, you could have covered it so well, Suzanne, that there aren't any, but I think this is sensational, highly relevant to what I do. My presentation, guys, is going to be about making you profit. But ultimately, what my job is to get you guys to work with Xact Accounting, because if you're making a profit, you need an accounting firm that understands what that looks like, and then how you can structure things and what you can do with that money to build more wealth. So this is brilliant. I'm actually been watching. Yeah, sorry, go.
Yeah, absolutely. And look, I've only scratched the surface on these issues today. There's so much more that needs to be covered in this space. And each of those topics I've talked about could be a webinar on their own. It's just quite complex and detailed when you get into this area. So it is important that people understand what they're getting into when they kick off these projects.
Yeah, no, this stuff is gold, man, especially like in my world. This is sensational. So Megan's asking, will we get a copy of this recording? Yes, absolutely, Megan. You will get a copy. In fact, I'm going to be, everyone who's registered, and I know some people won't register for webinars because they can't make it, so we'll send the recording out to all of them, but I'm going to send this out to all my clients anyway, because they need to hear it. This stuff is invaluable. Yeah. Megan's saying, we're just starting this area of work. This has been great. Thanks. Yeah, couldn't agree more, Megan. Fantastic. You got me excited, Suzanne. This stuff's great, because we have people making money, but then as soon as they enter into that area of making a profit, which 90% of businesses don't, then it's like, well, how do we make sure we're not paying too much tax, but we still need to show enough profit for home warranty and also for serviceability to buy properties. But then once you start buying properties and flipping, or you're going to buy and hold, what are the implications then? And obviously you guys can answer all those questions. So this is about teaming with the right people that understand the space, because it's rare. Most people don't. You're talking about the top 3% really that get this right.
Exactly. That's exactly. Yeah.
Awesome. All right.
Thanks. Thanks, Kurt. We might keep it moving.
Yeah, well, thank you. You got me pumped, as you can see, but we're going to hand over to Dan. So there he is. All right, Dan, stand by. I'm just going to make you the presenter, and then guys, you're going to hear from Dan Wilkinson and then me afterwards. Enjoy.
Yeah, thanks, guys. So I'll wait for that little pop-up to come through, Kurt. Hope it's not far. Show my screen. And
yeah, I've sent that through. Have you got anything there?
Yep. Do you see it now?
Yeah, perfect. Okay.
Yeah, fantastic. Yeah, g'day, guys. Thanks again for carving out a bit of time for us, myself, Suze, Kurt as well. And look, I'll be covering a fair bit of ground today in my section too. So I'll be covering twofold. One is work in progress, the importance around it, why we should care about it. And the second side, I just want to show off a bit of tech that we have been working on in the background as well, which is a tool called Xact Analytics. And I'll run through that in the background too. So I'll just jump into work in progress first. And this is really relevant to builders and sub trades. Whenever I have conversations with builders all the time, they go, hey, Dan, look, I've got my finger roughly on the pulse as far as profitability goes, but I just can't see overall how I'm doing. Look, there might be a whole month where I don't push out a claim. I've got a huge loss, and the following month you do push out that monster claim, you've got this big profit. So your numbers go up and down like this all the time. Now, you can pull the revenue and the costs into the one period, and that's called work in progress. So there's no reason why you can't pop open your profit and loss statement and go, right, let's have a hard end of month close, fold in work in progress, because the philosophy behind it is pulling revenue and costs into the same period. And you should be able to see how much profit you are making by a month, not trying to average 3 or 4 months or 5 months, or especially in the run up to Christmas. Like obviously you guys push out a huge amount of claims coming up to December. January is usually really quiet because everyone's off the tools, and February is another little loss period. And then obviously the run up to April as well, Easter and all the rest of it too. But if you have strong work in progress processes in the background, there's no reason why you can't pop open your profit and loss and go, yep, I actually made $35,842 this month. You can do it. All the big guys do it, every single one of them. It is standard practice for those guys. So without further ado, I will push on. So WIP is really hard to get right. I'm working with a couple of builders now. One guy is really sophisticated. He's an ex-banker, and we're probably into month 5 or 6 of trying to get his WIP under control. And look, the reason why I want to sort of do, I guess, get WIP under control is the builders or the owners or the stakeholders, whoever they happen to be, family members, better halves, they just want clarity on their numbers. They're really good at sort of putting the quote together, eyeing it all out, quoting out all the sub trades in their labor materials. But when the whirlwind starts, invoices go over and cash goes everywhere. Job costing is obviously really important, but a further subset of that is the work in progress piece as well. And again, it's all around sort of pushing costs and revenue to the right period and go, well, if we sweated out $1 worth of effort and we had 20% margin on something, let's recognize $1.20 worth of revenue and go, right, how much money did we actually make this month? So if you aren't using WIP, you're definitely running your business with a blindfold on, because your numbers will bounce around all over the place. If you have 3, 4, 5, 6, 7 jobs on the go, you go, right, well, if I want to know how much money I'm making, I have to look a little bit at job costing, do I sort of try and average these 4 or 5 months? Where's it sitting? If you fold WIP into this, it will definitely work for you. Yeah, promise. And look, obviously WIP gives you clarity on how much money you're making in the background as well. So you should be able to run a profit and loss at the end of September, October, once you've worked out your WIP, and go, right, this is how much money I have made overall. I touched on the roller coaster before. I mean, I look at a lot of builders' profit and loss statements daily, probably new ones that do come through, and they bounce around with that WIP. And a lot of the time, WIP isn't part of their sort of day-to-day process. And they go, look, I'm really good at sort of executing, good at the sales and marketing, got heaps of leads on the go, Dan, but when I look at my numbers, I'm just not quite sure where they're landing. If you fold WIP in there, you should have like a nice little linear view as to what your profit is doing. And I have got an example that I'll take you guys through in the background. Definitely get WIP into your reporting. If you get nothing else out of my section, definitely rewatch this video or do your own sort of research on it. If you work on it and put some time into it, I promise you'll get a lot out of it. The other big piece as well is knowing whether your WIP is positive or negative, and that's really important when you look at cash, because you might have a new project that rolls out and you might be doing the full work and the concrete pour, the slab pour, and go, right, well, that's going to cost me 20 odd K to sort of get that all out, but I'm going to ask the client for an 80K deposit as part of a bigger piece. Well, you've made some monster margin off that claim, but you've obviously front loaded some of your contracts, so all the 80K isn't yours yet, because you have managed to sort of pull cash flow in, but you are carrying negative WIP there, or essentially unearned revenue, we do call that in the game as well. So, and then with the positive and negative WIP too, when you do calculate it at the end of the month, how does that go against your cash? Because if you're carrying large negative WIP, which means obviously you've front-loaded contracts and gotten cash in, but then you have a low bank balance, that's dire, really bad. So what you want to do ideally, if you can run negative WIP, great, which means you're obviously using the client to fund your projects or the banks. But if you can run positive WIP and obviously a large cash balance, that's great. And the big thing is do it monthly at a minimum. You probably don't need to do it weekly, but all the big players do it. They do their hard end of month close, crunch through the numbers, pull all the revenue costs, and go, right, how much money did we make? Feedback loop, this is the actions of the accountants, these are the actions for the builders, project managers, whatever it is, and then rinse and repeat, get to the end of the next month, put your WIP in, accrual accounting, et cetera, how much money do we make, and then rinse and repeat. Just take the guesswork out of it, I guess. And ultimately, if you fold WIP in, you can see if you're making money or not, especially the timing of it as well, hard end of month close, and it should give you a lot of clarity into that. And builders always knocking our door, and 9 times out of 10, probably even more, it's like, hey, I just need some clarity in the numbers. So WIP will give you that. So let's just run through a light exercise on how to calculate it. I have done a previous webinar with a colleague here internally, and we are just skimming across the surface of this, but there's a QR code here if you're interested, I guess, in the full length video as well. I'll jump back onto this in a second, but let's just go through the WIP template really quickly anyway, because I think it's worth the effort. So really quick, and apologies for the timing on this one, guys, but I just wanted to reach all the punch points. So this is a builder here with no WIP, really simple P&L. I've just gone down to gross profit. Here's the months across the top. Here's the revenue that's come in, 92K for September, 264, so obviously a large claim month. July was a monster, June was a little bit smaller, and May was a bit smaller as well. So you can't time the timing of your claims all that well. If you have rain or delays, you'll shove these around all over the place. But your costs, for whatever reasons, do seem to keep coming in all the time too. So when you go revenue here by month less your costs, you can see here down the bottom, look, this is probably really familiar for a lot of you if you're not sort of folding WIP into your process. You've got a 38 grand loss here, you haven't even paid for overheads yet. Revenue here, well, I guess GP here is through the roof, 122K. If you guys are making 46% of your jobs, rock stars, but again, we know a lot of that revenue is probably not ours. Again, another high GP month, loss. So when you try and look at the P&L and go, geez, how much money am I actually making? Do I try and average this, or where's it up to? It can become really hard as well, because I know if you're in the resi space and commercial space, 46% will be well off the mark, but WIP can help you get clarity. Super quick, this is a builder that does do WIP. So they've recognized the value of their costs, pulled in the revenue. There's a WIP, I guess, a WIP reversal and a WIP accrual. But ultimately, at the end of the day, when you come down to the GP, it smooths it out nicely. You should be able to see how much money you are making at a point in time. I'm not trying to do the guesswork here and trying to averaging several months or whatever it happens to be. If you fold in WIP and the calculation's right and accurate, that 54 grand should be yours. That 49 grand should be yours, not these loss periods that are in the background as well. So again, there is a separate calculation video on this. I'll pop up the QR code again in the background. So if you have any questions, definitely feel free to reach out to any of us that are on this call today. So the WIP calculator, there are a lot of numbers in here, but definitely don't be daunted by it. It's pretty simple overall, but again, it relies on a fair bit of data hygiene as well to make sure the numbers in here are tight and are accurate. So this template's available on the website. Definitely have a crack at it. More than happy to have a look at it, guys, too. If you have a crack at it and you can't get through it, happy to take a call on it or a Zoom, whatever it happens to be, because it's so important to get right, especially on clarity on your numbers. So when filling this out, just work left to right, top to bottom. So if in this example here, there's a job on the go, either putting in, I guess, your job details from Builder Trend, Build Xacts, whatever it happens to be, Job Man, Procore, drop these in here, rough start and end dates, and then this section here, this is all your quoting. So hopefully you've got a rock solid process around your quotes and how you build them up and all the rest of it. But working left to right here, this is the contract value, including GST. There's a couple of little prompts here as well telling you whether you need to input the fields or whether there's a formula there as well. So just work left to right, hey, this job here is worth 550. I've got a couple of varies underway here, which is adding another 11, including GST. So the contract value, ex GST is 510. So basically just sums these two together, divided by 1.1 gives you 510,000, because unfortunately we don't get to keep the GST, that goes to the government. I'm planning to spend $410,000 on the build all in, so I'm planning on making 100K. Let's defend it and try and look after that as best we can. And then over the side here goes, right, well, this project's running here at a 20% GP. So this one here must be, I guess, an architecture design home, and this one here must be a reno, just given the GP at the bottom. So you wouldn't expect these figures here to change much, but when you're doing your WIP monthly, just be a bit careful of variations and just override the top of these as well, because this can be a bit fluid too. Now, rolling over to the right, this is all your data from the accounting software. And what you want to do is, again, just work left to right, and we've broken this down into a few bite-sized chunks. So if you do have strong job costing processes in the background, what I mean by strong job costing is every single direct cost invoice that goes in your accounting system gets allocated to a job, or near enough. I mean, probably ignore a supervisor that sort of floats across multiple projects, but every material invoice, every sub-trade gets coded against one of these jobs. So you should be able to just pop open your accounting software and go, right, as of the end of September, I've spent 170K on this. I spent 23K here and 130K there. So I've spent 323,000 all up. Now, the big bit with WIP is that you really, really need to quantify where you're either saving money to quote or where you're tearing up money to your quote as well. And what I mean by that is, say you have in your quote, you have a nice retaining wall. It should have cost you 10 grand all in to sort of land it. And look, with my CFO advisory hat on, if you're sort of spending 10 grand on the retaining wall, who cares? Move on, you've hit your budget. But if it's coming at 12 grand, you've cooked 2K of that profit. Now you're set to make 90 out. But you want to try and capture the overruns and underruns throughout here as we go, because you don't want to artificially inflate the WIP. Because if you have an overrun here, there's no revenue associated with that. So you do want to try and capture that where you can. So working left to right here, we can see here that there are some costs that the builder knows that they have overspent here in the background, being around about 50 odd K, but it isn't sort of coded against the job all that well, but they know at the back of their mind, hey, this one's sort of sticking out like a sore thumb. And the other side is, what are the non-project overruns in the background too? So of that 170, how much of that is overruns as well? So it's no longer going to cost 410,000 to complete the job. It's now going to cost 475,000 because we know we're overspending on this job for whatever reason. So our cost budget is no longer 410, it's now 475. And now, unfortunately, our GP's gone from 100K down to 35, and we're only going to make 7 cents on the dollar for whatever we generate in here as far as gross profit goes. So it's really important to try and identify these where you can, otherwise your WIP number becomes really, really wobbly in the background too. So just work top to bottom, left to right on this. One, just sort of break the back of your existing projects as well. You get into a rhythm and routine. It gets easier. Similar to exercise, the more you put in, the more you'll get out of this process. And then jumping over to the right-hand side, the big important piece here is this section here. So what this section does, or what this section tells me, it goes, right, from this $410,000, which now has an overrun of 65,000, we're projecting that this is going to cost us $475,000 to build. And then in the background, we're going, well, there's 170,000 here plus costs that aren't in the right category. We've got 220 grand here. 220,000 on your 475 is 46% complete. So what we're trying to do there is go, well, from a cost perspective, we're 46% of the way through the project. And what we should be doing is you should be recognizing 46% of the revenue and 46% of the margin. Because you might have banks pulling back on claims, or the client might be being a little bit difficult, not sort of signing off on a claim as well, in which case you're going to have that bounce around with your P&L. So in the background, we have only billed 200K in income. If we're recognizing 46% of the income, it should actually be $236,000, because you've obviously sweated out more dollars, more effort, but you haven't had the income recognition to support it. So you're actually carrying positive WIP there of 36,000. So when you go top to bottom here, this one's carrying a little bit of negative WIP. As from the example before, they've only invoiced, they had invoiced 70,000, they're only 4% of the way through. They're actually only entitled to 28% of the income, which is 4% of the costs incurred on the income. So they're actually carrying negative WIP here, which is great for cash, but just don't go out and buy yourself a toy or something. And then down there, and then when you sort of run top to bottom here, they're actually carrying $100,000 worth of WIP. So what that means is that if you're sort of feeling cash being a little bit tight and you're a little bit nervous, and I guess you do the back of the envelope calculations for WIP and cash and timing of those invoices coming in, there's more cash coming in the future because you have incurred, as far as the effort goes, and particularly around the costs, about 100K worth of income that you haven't got in the business yet. So keep in mind, WIP is in cash flow. It is mainly around profitability and making sure the business is sitting in the black, because if you're not micro measuring your margin, I promise cash as a byproduct will always hurt. So that's probably the big piece around WIP. I'll just go back here. I'll just flash up the QR codes. We have done a longer piece around WIP for builders in the background. So this one I think goes for about 30, 40 minutes all in. Scan the QR code again. This will be in the video a bit later on, but if you get nothing else in my section, please have a look at work in progress, especially as you're getting bigger and more complex and you go from 1 or 2 jobs, you sort of explode out to 3, 4, 5 jobs, and you add more heads into the business. I strongly encourage you to have a look at that in the background too. Now, changing gears a little bit, we'll jump across to Xact Analytics. So this piece here, and again, this tool uses Microsoft's Power BI. It's a product from Microsoft. It develops dashboards. I've got a full-time Power BI person in my team, and we just crunch away at dashboards sort of all day, every day with that individual trying to help clients. So this is about 5.5 months worth of blood, sweat, and tears. For those of you guys that do use Build Xact, this links into Build Xact at 0, almost live. So this dashboard refreshes every 6 hours. So if you have your bookkeeper, better half, smashing in data all day, you can pop this open at any point and have a look at how your financial performance of your business is going as well. Now, the reason why we sort of created this is I think Build Xact is amazing upstream. The takeoffs and the quoting and all the rest of it is excellent. The guys in the US are pumping heaps of money into the usability, the user interface, and all that. But as soon as you sort of go downstream, and when you turn it from a quote into a job, which is the bit that I care about, the CFO advisory, once the rubber hits the road and go, right, well, we've got a 600K build, we want to build it to 500, we want to keep 100, we want to defend that 100 as best we can. Just the visibility out of Build Xact isn't that great, and even the work in progress piece isn't that great out of it in the background too, without knocking it too much. So we're trying to commercially lens the data that's in there, because if you have really good data, this dashboard works really well. I mean, we try and commercially lens it so you can go, right, how much money am I actually making at a given point in time? So it isn't as powerful as, I guess, having like a strong business advisor or coach in the background like Kurt or someone like me, and there are a couple of us out there. But it does sort of shine the spotlight on the business, so you can work out where the holes are and where the bleeds are and where the upside is as well. And you can sort of go a level deeper than that. So this dashboard here, I mean, it's in alpha stage. We're releasing it to builders slowly. There'll be a QR code, which I'll flash up a little bit later on, but we aren't releasing this to mass market just yet. We're just trying to find a couple of builders, or quite a few builders actually, if we can, to sort of release it one by one and get a little bit of feedback on it. But I'll jump into the detail anyway, because I know everyone's busy here. But essentially, this is really portable. You can get it on your phone, tablet, PC. Again, refreshes every 6 hours. The first 3 tabs here are all 0, and I won't go into too much detail now, but the idea of it is that it's very portable, a couple of clicks. I might show you this really quickly anyway, how this works. There's a bit of a dynamic P&L here. You can pop this open, and you can go right click, drill, it'll take you to the transactions. And then if you click on that there, it'll actually take you to the link 0. So within a couple of clicks, you can drill down really quickly. You can select any month, quarter, period, and all the data will refresh. But I think for everyone on the line today, we'll probably just go to the Build Xact side of it, and I guess the commercial lensing piece as well. So bear with me here, just while I take you on a journey just with what this means and why this piece is so important. So this builder here has 3 jobs on the go, and for those of you using Build Xact, I mean, this will translate to build a trend. Even though you can't use this data in build a trend, the philosophy is exactly the same, and this is where you need to hammer down and sort of pull your business under the microscope here. But this builder has 3 jobs on the go. This is the planned profit or the quoted profit they want to make. So this job's going to make 120. This job we want to make 160, 182. This column here is the money maker. So to be honest, when I'm sort of sitting down with clients, I'm talking about the build and what's going on. If they say, hey, look, I've got a fence installed, should be costing 20K. It's coming at $20,000, 200. Look, to be honest, I couldn't care. Let's move on. But if we sort of sit down and go, hey, this fence is 20 is coming at 32, or something else, that overspend of 12 grand appears in this column, and that's the bit I care about. So whether you're spending under or over, this isn't what you spent. This is where your profit's eating away, and it's eroding this. Because if it comes, again, if the retaining walls come in at 10, and you quoted 10, that won't move. But it's coming at 12, you've lost 2K of that profit, and that's the really, really, really important piece. So hoping to make 463. We chewed away 98 grand worth of profit. We're now seeing at 365,000 as of the last few hours. These are all our margins, and this is our margin slip. And with some of the stuff that I do, I like having numbers and graphs. This is how much I'm planning to make. This one's actually gone up in profit, 182. We managed to save some money, contingencies, or swapping out materials, whatever it happens to be. Now making 187. This one's starting to cook. This one here, holy crap, let's go have a look at that one. And this is how much profit we're planning to make as of essentially right now. So coming into this a level deeper, we go to the Build Xact side. So with this tool, this all live links to Build Xact. There's no spreadsheets or anything you pull in or out or anything like that at all. So it is all live links. I'll just bring up one of these projects here and just sort of talk through quickly. So that for those of you using Build Xact, this section here should be really familiar. So depending on how you build out your recipe or how you do your quoting, here's your preliminary site prep, estimate, actuals, variance, and I'll come back to that one in a second. But in the top left-hand corner here for this project has an income of 542,000 ex GST. There's no varies. There's $421,000 worth of costs. So we're hoping to make 120K out of this, or 22 cents on the dollar that we generate out of this, or 22% gross profit. Now, if you come across to the right-hand side, we can see we've built out the entire $542,000 to the client. So there's nothing yet to invoice. So that's the total cash inflow. Scrolling on further down, this costs incurred here, this is what we spent to date, $477,000. As you can see here, there's $421,000. So you as a builder might look at this currently and go, oh, Jesus, I hope that's everything. And if you don't have a strong purchase order process in place, you're going to look at the $477,000 plus the 5 or 6 others and go, Jesus, I hope that's it. But it gets worse than that. So out of that 477,000, this builder has overspent 101,000 of that. And then on top of that as well, there's still 44 grand yet to come in on top of that. So this here is the number that I care about most, which is critical, because when you fast forward over here to the profit protection, we're planning to make 120. We've torn up 100. Now we're only going to make 19 grand, or given away 84% of our profit. So now we're sitting at 19, and this is our new GP, which is not very fun at all, to be absolutely honest. And then when we come back here, the costs yet to spend, if those additional costs come in, so in this example here, we have the swimming pool and hard landscaping, which hasn't been done yet. If the swimming pool and hard landscaping comes in at exactly 31,000, that number there won't get worse. Not good for cash flow, but that number there won't get worse because we're trying to pull the profit under the microscope. But if it comes in at 32, that's going to get $1,000 worse, and that's the bit that I care about and that builders should care about the most. Scheduling, all that's important, but particularly from a profit protection piece, what is the money that I'm tearing up here? And that's the thing we want to pull under the microscope. So when you pop over to the right, here we go, well, if we go top to bottom, here's the estimates, here's the actuals, and again, this is all directly from Build Xact. We can see here in the preliminaries, we'll pop this out, some home warranty insurance. We thought we were going to spend 6,500. It's coming at 7. We've torn up 400. So that 400 comes out of here. And then as you go top to bottom, you can sort of see where all that's landing. So this project is cooking a little bit in the background, well, quite a fair bit. And you can pop these over as live linked. And if you click on any of these, it'll take you direct to Build Xact. So within a couple of clicks, you can sort of see projects where they're up to. You want to keep that one under the microscope all the time, daily, even if you can, especially bookkeepers pushing in data daily. This will update daily. And then down the bottom, you go, oh, geez, what's yet to come in? You're basically trying to look for anything that has blanks. And you come down to the bottom right-hand corner here, swimming pool and hard landscaping. I've got an estimate in here, but no actuals. Oh, Jesus, okay. So I've still got to spend another $44,000 here because I can see there's gaps there. Now, even if you aren't using Build Xact, you can do this with Builder Trend or Jobman or Procore. The theory is exactly the same, just the journey there's a little bit different without this, I guess. And you can do this by one job, all jobs, some jobs. So this one here, for examples, is just kicking off. They build 194, they spend 26, but it's already cooking. So you want to try and keep that under the microscope. And the other little bit I like about this as well is it gives you a bit of a micro cash flow down the bottom. So you go, well, I've still got yet to invoice this. The cash I'm yet to spend is this, or actually cash flow negative as far as it stands here. And then if you want a high level, and I see builders do this all the time, back of the coaster, this claim is one thing that was finished and all the rest of it, you can do it business-wide. So if you have a bucket load of jobs, it'll appear here as well. And you can go, right, well, I've invoiced out all this money. We are cash flow negative at this stage, but that's fine because you might have forward load of contracts or wherever it happens to be, but just be aware of that. You might have lots of cash in the bank, but your cash flow on this is negative as far as this goes for the projects. So I know I've glossed over this a fair bit. Yeah, look, I think it's a really powerful tool. Upstream, I think Build Xact is amazing. But yeah, I mean, particularly you sort of go downstream and the quote now becomes a job. And I guess you want to sort of try and commercially lens this too, and especially try and have that money under the microscope where you are tearing up the cash. And we've come out of it, from a pretty bumpy ride overall. Yeah, it's just really important for that job costing, that job profitability, that you do maintain and defend that where you can. And some of the feedback I've had from some builders on this as well is that there might be costs coming through. They can jump in really quickly, see where the business is up to. And there's been quite a few variations missed out of this process too, because you'll see this huge cost come in, but then there might have been some paperwork that might have been missed as well. So variations are a common piece that pop out of this as well, as far as feedback goes. So here's a QR code if you want to scan it. It'll be on the recording, but yeah, welcome any questions that anyone has in the background, and that's my piece, Kurt.
Fantastic, Dan. Thanks for that, mate. Really impressed. I just want to say this is the first webinar I've run with you guys, and you're speaking my language. You seem to be very objective as well in your approach. I'm product agnostic. I don't take kickbacks from any companies and accept money and try and guide people to any specific product. It sounds like you guys are in a similar situation. You're just looking for the best option for your guys, yeah, which is brilliant. So we will definitely be doing more of this in future. I'm going to send this recording out to all my guys, all my private clients, plus also we've got a couple of closed Facebook groups with about 2,000 builders on there. I want everyone to see this because it's invaluable, yeah.
Amazing, thanks, mate.
No, really cool. I'm just checking the question. It doesn't look like there's any questions. If any, guys, if you have any questions, please type them in the question box. I'm going to, just conscious of time, I'm going to jump into my segment to wrap us up. And then, yeah, if any questions come up, just type them in there and then we will address them at the end. You guys going to stick around, Dan, just in case?
Definitely, yeah. Thanks very much. Thanks, guys.
Okay. Fantastic, man. Thanks again. We'll see you on the other side. All right, guys, I'm just going to make myself the presenter. Let me see. And all right. Hopefully you guys can see that okay. If that's not coming up, just let me know. And I'll sort it out. But guys, I'm going to be talking about pricing for profit. So again, everything that Suzanne and Dan spoke about dovetails beautifully with what I'm going to talk about, right? So I'm going to talk about pricing accurately, making sure you price for profit. I work with builders all over the country, by the way, all over Australia and New Zealand as well. So no doubt there could be a few Kiwis in there. So this is going to be relevant to all of you. I'm also going to be talking about how to get more negotiated tenders. I know right now, in the last sort of 12 to 18 months, there's been a lot of activity, a lot of work, but I am starting just recently to see pockets of people, and maybe you guys are experiencing this as well. Maybe not so much in Queensland, because Queensland is a very popular state. There's a lot of interstate transition of people moving up there, but there's definitely certain areas where people are either cancelling contracts or inquiries dropping off, or both. All right, so obviously the building industry tends to lag, what happens with the stock market and that. So my key message for you guys is you want to always be marketing aggressively, right? You always want to spend time and energy on that front end, so you've got more inquiry than you need, and then have a great sales process, which we'll be talking about. And then that puts you in a position where you can have more negotiated tenders. So if you're wondering what a negotiated tender is, it's just a one builder tender process. So you would have all had that happen. Someone comes to you, they already know, like, and trust you, maybe through referral or whatever it is, and they want to work with you. So there's no competing quotes, which means you're licensed to crank your margin, all right? And I'm all about optimizing your profit, workflow, cash flow. That's what we do, putting structures and processes in place to do that. We're going to look at your bookkeeping as well, as how to set up an accurate profit and loss. Really simple, but very, very important. If you don't have the right financial structures in place, which is why I love what Xact Accounting does, it doesn't really help to have great marketing, to have lots of quality leads and inquiries coming through if you don't understand your margins, the cash flow, the profit, and then also what to do with your profit. Like if you're making a good profit, which 90% of businesses don't, as I mentioned before, then it doesn't really, there's no real use in making a profit if you don't know what to do with it, right? How to then use it. And the best way to use it, if you're a builder, by the way, from my experience, is to do developments, and then to potentially buy and hold properties and flip some. I'm not going to tell you how to invest it or what to do with it. That's where, again, Xact Accounting comes in and can help you with that. And by the way, it's rare. I can tell you right now, it's rare to be able to engage with an accounting firm that understands this stuff, right? And it makes perfect sense why it's so rare. It's because most guys don't make a profit. So most accountants don't see profit, so they don't know what to do with profit and how to best manage it. These guys obviously do, which is great. We're going to look at how to successfully outsource your estimating. Some of you might be going, yeah, the blood's draining from your face as I speak, because why would you want to outsource that? And maybe you've tried it and it didn't work. But we have some of the best estimators in the country that we work with. And if you're charging for quotes, which we'll talk about, you can then outsource to some of the best estimators. And that takes that whole quoting thing off your hands. I know you guys love quoting and you get off on it and you don't want to let it go, but it's a great thing. I'm joking, right? I know most of you guys don't enjoy it. So it's an opportunity to free up time. How to optimize your cash flow. It's simple and easy. It's payment schedule, which we'll talk about. How to find the hidden profit accelerators in your business. So like with a job, there's sort of your critical path. There's certain areas of the business that serve as that are critical distinctions, small hinges that swing big doors, and there's things you can do that'll quickly optimize your profit. And we'll look at those and how to help your people do more with less time. Automation is absolutely key. A big part of it, again, is that front-end process, but also using scheduling tools. In the last 5 years, you've seen a real kick in the use of scheduling tools like Build Xact, Build a Trend. Again, product agnostics are not pushing any product. And by the way, there's no one product out there, software product that serves everyone. All right, it's a very individual thing, which is why I offer one-on-one coaching. It's a very individual process. Everyone's different. So goals and aspirations, and everyone's business is different. So I really enjoyed taking people through that transformation. All right, we're just going to cover plenty more. So let's jump in. Let me keep an eye on the clock here as well. Just make sure we get through everything we want to. By the way, there's very limited time today. I could keep talking for a week. We run one-day workshops. I do a lot of one-day workshops, training workshops with the HIA, with the MBA. I did one with the HIA here in New South Wales last week down the south coast here in Wollongong. I've just been informed the last week or so that we're going to be doing 4 one-day training workshops with the HIA in Queensland next year. Okay, they've got a government grant to spend, plus a couple of webinars. So if those of you who want to interact next year, we can do so. But I've also written the book. That's what you're seeing on the screen now. It's called $1 Million Builder, and I'm giving it to you guys. I had someone get aggressive with me on one of these webinars, saying, this guy's trying to sell his book. I'm going to give this to you guys for free, no strings attached. If you want a copy of this book, because I can only cover so much and really skim on some very important areas of your business. If you want to do a deeper dive and there's certain things that I don't cover that are more relevant to you, you can find it in the book. The book's on Audible. You'll see it on Amazon, but again, I'm happy to send you a copy, a paperback copy for free. Just email book in the email header to info@builderscoach, that's builder with an S, builderscoach.com.au, and I'll shoot that across to you guys. Plus, I'll send you an audio link. In the book is about 40 documents and videos, okay? Lots of different checklists and things that you can use straight away. So that's the resource. This book is the resource for this webinar that we're covering off. So success in business depends on you, right? It's all about leadership. Leadership's about decision making, and you've really got to decide that you want to work on your business. So ultimately, you know, if you've done that, and I'm assuming the fact that you guys are on this webinar, you have made that decision to work on your business and yourself. Working on yourself and your leadership is crucial because your business will never outgrow your leadership, all right? So you got to keep working on yourself. And if you're doing that, you'll be on that green curve that you can see on the screen now. So you're moving up towards best case as opposed down towards worst case. And that's inevitability theory, really. If you've got a plan and you're working towards improving your business systems and efficiency and profitability, and you're working with the right people, you would inevitably become successful. But here's the ultimate question. It's a great book. I recommend you guys get it. It's called 12-Week Year. One of my clients referred it to me. We've always worked on a 12-week, 90-day plan, business plan. It's the best timeline for a business plan. It's been tested and proven. 12 months is too long. We all know how quickly things can change. So looking 12 months ahead is too far. 6 months still too far. 3 months perfect. Okay. And then it's what we call an accountability tool because there's nowhere to hide. You've got 12 weeks. You can see the finish line. Every week matters. Every day matters. Every hour, every minute matters. Right. So it's not the most comfortable thing. Most people are very uncomfortable when they look at a plan like that, which is exactly why most people don't do one, because they don't want to feel uncomfortable, all right? But I'd recommend you get the book and you listen to it. And while I was listening to it, the guy asked the question, which I found to be extremely simple, but also profound at the same time. He said, do you have a plan? And I'll ask those of you now, do you have a plan for your business? Is that plan aligned with your vision? And are you working your plan? All right. So if you answer yes, yes, and yes, you're in the top 1% of 1%, because the reality is even the biggest businesses on the planet, I heard this the other day as well, the biggest, most successful companies don't have a plan. 90%, they don't have that plan aligned with their vision, and they're not working that plan. So most people, and most of us on this call now, are winging it. There's no game plan, all right? You're just getting work, doing work, and moving along, and maybe there's some sort of direction that you're trying to steer the business in, but most people don't have a clearly defined plan. So that's a very important thing. all right? And if you don't have a plan, then this is, what your situation could look like. A lot of uncertainty, potentially things are going to go terribly wrong. Otherwise, if you're taking charge, it could go extremely well as well. Okay, but that's the exception to the rule. Just running through the different areas of your business. I'm just going to rapid fire through some of these because, again, we don't have a lot of time, but this relates to the book. If you grab a copy, there's 10 different areas of your business that'll be relevant to you regardless of whether you're a sole trader or you've got 50 carpenters working for you. There's strategy, which is your direction, the strategic direction that you take your business in, plus the strategy for the other 9 areas. What's your strategy for your marketing, for generating a consistent flow of quality inquiry, for capital, for building up working capital? I don't have to tell you how important that is. For sales, for conversion, are you charging for quotes? Do you have a well-defined process for qualifying people and ensuring that you're converting AAA grade blue chip clients and jobs in the right area? For your job delivery, are you delivering on time, to budget, and to standard consistently well? What's your admin like? Your paper flow? These days, you can run your entire business paperless, which I recommend you do to optimize efficiency. But what's that looking like? Your finance. Finance is obviously profit, cash flow. Okay, 2 words to sum up your business. And then workflow is really important, which is why, by the way, a business that it has a well-defined strategy, including marketing, where you are targeting a particular type of work, which is, whether it's luxury custom homes or renovations, but you're picking and choosing your clients and they're high margin in a good location and they're very agreeable, no banks, for example, and you've got a consistent flow of those leads and you're converting them into projects. That with a development arm, with non-client work, is the best model I've seen. Why? Well, you'll all know if you do luxury custom homes, especially the higher end stuff, it takes a long time to get to the point where you turn in soil, right? Sometimes 12, 18 months, 2 years lead time before a job starts. And inevitably, at some point, one of those jobs will fall over. People die, they move, they get sick, or whatever happens. And it's difficult to replace that job. But if you're land banking and you've got your own developments, you can just start one of your projects and keep it flowing nice and smoothly. But it's also a great way to build wealth, provided you've structured things correctly, which is obviously where Xact Accounting comes in. And that's really outside of my expertise. But my job as a coach is to have a good understanding, at least a general understanding of all these areas, to help you implement the right processes in the right sequence, and very importantly, point you to the right people. You see, team is one of the segments over here. And team really includes not only your team on site and in the office, but also your bookkeeper, accountant, your business coach, your financial advisor, your marketing people, all of the people around you that help make your business successful. But we can't escape finance. Important to finance, your financial systems, and then the financial outcomes as well, your profit and your cash flow. So we'll look at some of the financial controls in a sec. But there's your systems, and in this day and age, a lot of people I find are not taking advantage of the systems and technology that's available in the industry. A lot of guys are running their business like it's 1995 and they don't need to, so they're suffering unnecessarily, which is why we're really trying to get the word out. One of the guys that I'm working with, Tim Waring in Toowoomba, I think he's on the call. Tim's helping me implement systems with builders, and he's absolutely dumbfounded as to how many are not taking advantage of the information and the systems and technology that's freely available. Okay, so it's at your fingertips. Systems are, and again, relevant to every part of this wheel. You can have systems for your marketing, for building capital, for sales, for job delivery, and every other area. Systems for developing your team, recruitment processes, right? Someone leaves, how to replace them, there's a recruitment process. Now, it's very difficult to find people. It's probably the #1 challenge that I'm seeing out there, but you can still find good people out there who are looking. There are a lot of people out there are not happy where they are at the moment for obvious reasons, because there's so many inefficiencies and so many logistical challenges for most builders. The guys that don't have good systems and structure, their people are looking to move. So you can essentially headhunt, or not headhunt, but get people to shift across to your company if you've got your shit together. Then there's your leadership, and like I mentioned, your business will never outgrow your leadership, so you want to keep evolving and growing and have some sort of leadership development program in place for yourself and your team. You want to be developing leaders underneath you, and that's how you can step back and play more of a directional role in the business. All right, so that's just the profit wheel. Again, do you have a plan for how you're going to improve the areas of your system, of your business, and the systems in every area? But here's another question. How do your financial systems, your profit and your cash flow make you feel? Okay, so you obviously heard the Xact Accounting guys talking about financial controls. Dan was talking about WIP. We talk about profit, gross profit, net profit. What about your BAS, ATO, provisional tax, cash flow forecasts? When I say those words, how does it make you feel? Okay, be honest with yourself. I know for most people, when we talk about these things, it brings up anxiety, right? Literally a feeling of anxiety. And really, it shouldn't, okay? What you should feel is how you did when you were a kid. If you think back to when you're 9 years old and it's Christmas morning or your birthday, and you go downstairs and there was that gift that you wanted, whether it's the new bike or skateboard or whatever it was, or surfboard, that feeling, all right? If you could bottle that, that's how you should feel when you look at your financials. And that's what happens when you take control of your business, which is ultimately what this is all about, right? Once you understand how to run a business successfully and how to manage the finances and the marketing and sales and everything else all comes together, you have control over your business and then obviously your financial destiny as well. And then that is very, very exciting. So you probably know people that are successful in business, and outside of having kids, I always maintain it's one of the most exciting things you can do. It's well worth the effort to learn how to do this. I'm not here to say it's easy. Nothing worthwhile in life is easy, but if you get over that hump, it's very exciting. One of the things I always talk about with my clients on day one is profit first. There's a book called Profit First, written by this guy on the screen, Michael Michalowicz. I have not read the book, by the way. I've just applied what he teaches, which is extracting money out of your bank account before you do anything else. So most people, they have income minus expenses, which you see in a profit and loss, and then they take what's left, whatever profit's left, if there is any, and they invest it in shares, save some up as cash, real estate, and they generate passive income, which is an intelligent thing to do, but that doesn't work, okay? You're not gonna create any significant wealth doing it that way. What you wanna do is have your income minus profit equals expenses. Your business is a money eating machine. You wanna make sure you're extracting your profit first. I always teach this. Do it today if you haven't already done it. Set up a direct debit. I don't care if it's $50 a week, ideally 500 a week. One of my guys down in Melbourne the other day did 500 a day into an index fund, and there's great apps out there. I'll share the ones that my builders are using. Again, I'm not giving you financial advice yet, right, or telling you how to invest, but this is the guy who came up to me. He did this on the day that we had a seminar down in Melbourne about 3 years ago. He put in 1,200 a week, right, just into a cash account, not even an index fund or anything else. He came up to me a year later. He said, Kurt, I've never been able to save money before. I did this, check it out. He showed me his phone. I took a photo. And then he came 12 months later, he came up to me again, and he showed me he had 133. This is just pre-pandemic. And then in May, most recently, he sent me this. So this is to show you that this works, right? So here are the apps that most of our guys are using. All the banks, Westpac's got one, ComSet. I recommend getting some crypto, man. Like, we're not moving away from technology, we're moving towards technology. Finance is going that way. It just takes very long. If crypto does explode, again, I'm not giving investment advice. It'll be 2028, 2030 when it really kicks. So even if you buy $50 a week, better Bitcoin and Ethereum, and you can do it on these crypto.com or Bamboo, and you can automate it. It just happens, automate it each week. Ray is probably the biggest one on the planet. 500,000 Aussies on that one. Spaceship's a Kiwi product, as is Sharesies. All right, so moving along, let's look at retained earnings. So some of the people ask me, with those apps and profit first, and if I'm putting money into an index fund or a personal account, doesn't matter. The Xact Accounting guys can correct me on this, but if you don't spend that money, it doesn't matter. Okay, you like, say you're putting money into Raise, you're doing $500 a week. They're going to send you a report of all the money that's gone out of your business account into the Raise account, and then it'll show, like, maybe you put 20 grand into the Raise account plus you made 5 grand profit, so there's 25 in there. That profit then needs to be declared, and the Xact Accounting guys will tell you, will ask you, have you spent that money? Is that money still there? How do you want to declare it? Do you want to declare it as company tax, where you'll pay your 29% or whatever it is, or if you want to spend it, how do you want to spend it on something for the business or something personally? So there's different tax implications there. But if you don't touch the money at all, it's retained earnings. Okay, you've just kept the profit, the money there, and then that profit made you more profit, and you just got to declare that, all right? But this is the Home Building Compensation Fund guidelines in New South Wales, where they recommend, this is based on the research of builders that have gone under, They looked at, and they did exhaustive research, by the way, the government and insurance companies, with a view to protect your clients, all right, and mitigate the risk to your clients. And retained earnings, capital and retained earnings to turnover should be greater than 2%. So just as a rule of thumb, if you don't want to do any of the investment stuff I put into, you can put into an offset account, cash account, or something else. If you don't want it, if you just want to keep it in your trading account, you should have at least 2%. I'd recommend setting up a separate business account and then taking 2% of each progress payment and just putting it in there as retained earnings, okay? This is going to help your financial health. You want to build up buffers of money. Okay, so there you can see it. And ultimately, in order for you to optimize your profit and cash flow, you need a strategy, right? So the question is, what is your strategy for optimizing your profit and cash flow? And if you don't have one, like, don't beat yourself up. Like, the reason, it's almost absurd, especially someone looking from the outside in, someone who's not in business, they'll go like, how could you not have a plan? And how could you not have a vision and your plan aligned with the vision, and why you're not working your plan? And how come you're in business to make money, but you don't have a strategy? You haven't sat down and thought about how you're going to make profit. And there's research to show, 48% of the guys that walk away from their business and go under didn't have a strategy. When they were asked, what was your strategy for making money? They'll go, we didn't have one, all right? So there was no plan, which sounds absurd, but it starts there. Okay, so what is your strategy, all right? So you've got to have one, and I'd recommend not reinventing the wheel, all right? You can come to someone like myself, Xact Accounting, and find out what other guys are doing to optimize their profit and cash flow. That's the beauty of the world we're living today. You don't have to reinvent the wheel, right? You don't have to start by inventing fire, right? You can go to people who've already done what you want to do and follow in their footsteps. And this is where I see young guys screaming past the older blokes. There was a guy in the room last week, case in point, he is competing against the silver fox, this guy's in his 20s, competing on big projects, like 2 million plus in his area, which is considered, significant. And he's beating these guys, even though the older guys are scratching their heads going, but we've been building this area for 25 years. We've got a huge portfolio of work, and people are going with this young guy who's only done a couple of projects, and they're doing it because he's got good process and structure. He's process driven. He's given them a lot of confidence in his processes and how he builds, and he's growing rapidly. Like I say, screaming past them. Another question I'll ask you is, what's the difference between markup and margin? And this is going to be us transitioning into the costing space. Because quite simply, going back to the Home Building Compensation Fund guidelines, your margin needs to be at a minimum 20% margin. Now, a 20% margin is a 25% markup. All right, and I'll explain the difference very quickly by way of an example. Like if you had a job where the costings for materials and labor were $100,000, if you mark up 25%, so easy maths, right? 100K costings. Very important that you cost yourself in for any supervision project management as well at an hourly rate weekly allocation, plus your materials. 25%, 25 grand, right? So you put that on top. That's your gross profit. Forget about overheads. You're not going to try and allocate overheads to the costings. It doesn't work. We'll get to that a little bit later. That 25 grand goes on. That's 25 grand gross profit. You're still going to pay your overheads. The total figure to the client, their invoice is 125 grand. That $25,000 profit is 20% of 125. Okay, it's not 25%. It's 20% of the total. So that's the difference between marking up versus margin. It's fascinating that it's important for your clients that you have a minimum 20% margin, otherwise they will be exposed to risk. And that risk is obviously, if something happens, and you'll see this happening no doubt in your area, where a builder goes under halfway through a job, the client's renting somewhere. I know someone who's doing that now here in Sydney, where they're Airbnb, and it's costing them 10 grand a month. The job's being delayed, they're running out of money. If the builder falls over in that scenario, the people can't move back into their property. It's a horrible situation. If you go bankrupt, it's not pretty, but there's things you can do tomorrow morning to make money. You could, you could hire a hubby, you could do maintenance work. There's things that you could do with your skill set to make money. That people in that situation, your clients, it's horrible. Okay, so it's fascinating though that no one's educating the Australian public or the Kiwi public on the need for your margin to be at a certain point, because they're part of the problem. They're trying to drive you down. They think you're too expensive. Okay, so that's the starting point, is at 20. So if you had 15 or 10%, you don't want to be there. Okay, chase the margins and the revenue. If you guys haven't been listening to anything I've spoken about so far, then listen to this. This will be the most powerful thing you learn, all right? And this ties into getting accurate individual job reports and having good, accurate bookkeeping and accounting. If you look back at your last 10 jobs, 10, 15, 20 jobs, depending on how many you do and what size, you'll find that the margin's not the same. The profit that you make on those jobs is not the same. It'll fluctuate, all right? It's not going to be exactly the same. So the question is, if you look at your last 10, 15 or 20 jobs, what are your most profitable jobs? Why are they the most profitable? And what are you doing to target more of that type of work? Because if you just did that one exercise, and I know because this has been researched, most businesses, not only in this industry, do not do this exercise. They don't stop, generate the individual job reports, mainly because they don't have the bookkeeping or financial controls to generate reports that are accurate. But if you did, and for some of you it may take a while, you've got to do, you know, get paper and pen and really crunch the numbers. It's well worthwhile. Find out what is most profitable, establish then to, or decide to do more of that higher margin work, and then you could, using the same turnover, make a hell of a lot more money. Okay, you don't have to increase the volume of work, you'd make more profit. In terms of your reporting systems, obviously Dan spoke about WIP. There's your profit and loss, balance sheet, break-even point. We use cash flow forecasts and revenue projections, which are like windscreens to look forward out into the future with what's coming up. No doubt you guys would have a good understanding or some idea of what you've got lined up for the rest of this financial year. Some of you will be booked out with work for the rest of this financial year, and that'll reflect in your forecasting. Your profit and loss, really important that you have your cost of sales separate from your fixed expenses. That's the biggest issue I see when I look at people's numbers when we first start out. And I'll show you an example of a very simple breakdown, all right, of a profit and loss. Ultimately, you want your income, and it should reflect, the income from individual jobs. In this case, you've got a red house, blue house, green house, yellow house. There's your total sales. Then there's cost of sales. Cost of sales is just the cost you incurred as a result of signing those contracts. So you sign the contract, and then there's your bricks, timber, steel, your subbies, and this is really important. I had a conversation with one of my builders this morning about this. There's your time for supervision and project management. There's your carpenters, there's your apprentices, there's your labor. That is cost of sale, all right? I often see those wages down here where they should be up in cost of sale, and then you get your gross profit. Like I said, 20% gross profit margin is the minimum where you should be playing. With our guys, that's 25. We had a guy in the room in Wollongong last week. We did a little margin comparison with everyone in the room, with everyone's permission. The guy he's got 9 jobs on the go now. They're all between 2 and 4 mil. So he does luxury custom homes, and his markup is 35%. So 33% markup is a 25% margin, and that's just below average for the builders coach community. Bearing in mind, I'm working with the top 10% of builders, right? But that's just giving you a yardstick for where your margin should be. But you've got to have these costs, your cost of sales, separate from your fixed expenses. The fixed expense is just any other cost you'd incur, regardless of whether you sign a contract, right? Now, you may wonder, like, why do we need to know gross profit? Why are we separating these expenses, and why do we have gross profit and then net profit? Isn't your net profit the most important number? Because you could be turning over 20 mil, but you could be losing $1 million. You know what I mean? It's not about your turnover. Your gross profit could be could even be at 20%, but then your net profit, your overheads could be so big that your net profit is 0 or less. So net profit, yes, is really important, but why do we need to know gross profit? And if you've got a friend or a family member who's an accountant, a big shot accountant, I'd ask them the next time you have like a family dinner or something, say to them, hey, look, there's this thing, gross profit, and then you convert the gross profit number into a percentage, and that's what gross margin is, right? Why is that important? And see what they respond with. There's 2 reasons why it's really, really important that we know and figure out an accurate gross margin number. 1, because we needed to calculate your break-even point, right? Your break-even point, your overheads divided by your gross margin percentage gives you your break-even point. Why is that important? Well, that's when the volume of work at a certain margin has covered your overheads. Now we know every dollar beyond that, every gross margin or gross profit dollar you make becomes net. So you start making a net profit. Again, 90% of guys don't do that, right? They only earn a wage. So that's the first reason. Secondly, understanding gross profit and being able to generate a profit and loss on individual jobs, and then converting that gross profit to margin allows us to compare the margin on jobs, which allows us to target the high margin jobs, as mentioned before, as one of the most powerful things you can do. So you chase the margin, not the revenue. Okay, so two extremely important reasons why we need gross margin. Most guys sadly don't have an accurate enough profit and loss. You'll probably find half of you on the call, you'll have your carpentry or supervisors down in fixed expenses. And then if you think about bringing on a new supervisor, it's $2.5 grand a week, and you can potentially take on more work, but it requires 2 supervisors, which is 20 grand a month. You look at the expense and it freaks you out, but really that's a cost of sale like materials, and you're preventing yourself from growing because you don't have accurate financial controls, which is why it's so important to have them at a foundation level. This is just an example of a cash flow forecast. It's a 12-week cash flow forecast. That's what I highly recommend if you're going to forecast 12 months. I saw a 12-month one yesterday with one of my clients in Auckland. And it's, unless you've got 12 months booked in, it's much better to have a 12-week cash flow forecast. Looking at your metrics, really important to have some idea, and you guys already would, what your turnover is going to be. What's your turnover goal for this financial year? How many starts does that equate to ideally? And then how many quotes for the starts? If you're charging for quotes, you'll be converting 1 in 2 at least, a 50% conversion rate. And then how many sales or site visits for each quote that you do, and then how many inquiries do you need to get those sales appointments, and also set a metric for your cash reserves, building up that working capital and retained earnings. It's one of the most important things. I've had that many guys set up profit first accounts, and then 3 years down the track, man, they get punched in the face, figuratively speaking, you know, by a toxic client, or something happens as an illness or worse. And because they've got the cash reserves there, they can deal with the crisis a lot better. The last thing you want is when you've got a crisis situation is to have financial issues as well. It's going to heavily impact your mindset. So pricing for profit, just to recap on exactly how you do it. You calculate your raw costings, including your time for supervision and project management at an hourly rate weekly allocation. So you keep timesheets for that. It's very easy these days with some of the applications out there that even tie into your bookkeeping system like Xero. And then you mark up a minimum of 25%. Okay, again, forgetting about your overheads. Why do we forget about overheads? Well, and this is important again, if you're not paying attention, please do so now. And it'll be interesting to see if the Xact Accounting guys can confirm this as well. But your overheads will only ever sit between 8 and 12% of your turnover. Okay, provided you turn over more than 2 mil. You need to be turning over more than 2 mil in a calendar or financial year to start making any meaningful net profit. Okay, especially if your margins are around 20%, because you still got to pay yourself a wage. But provided that is the case, then your overheads, if you extract all your site-related labor, should fall between 8 and 12% of turnover. And I often get asked, when do I bring on the next person? Have I employed too many people in the office? What's the marketing budget that most builders at 3 mil, 5 mil turnover have? You know, what should it be at? Well, the answer is, you know, what is your overhead percentage of turnover? Let's look at it. If it's at 8%, you can afford to spend some more money on marketing or employing someone in the office to free up your time. So that's the, sorry, I said a text come through, so I want to make sure it wasn't one of you guys. So really simple but powerful process for pricing accurately. I would highly recommend that if you're doing renovations, which is the most staple niche or specialty at the moment, that you use a minimum 33 markup, which is a 25 margin. Most of the guys I'm working with are using a 42% markup for renovations, which is a 30% margin. Okay, but also costing yourself in. Again, at least half the guys I start working with don't cost themselves in for supervision and project management, which means they can't then replace themselves down the track. And again, that's why a lot of guys don't grow. So there you can see in the compensation fund guidelines that 20%. And this is what they use, by the way, when they do your home warranty insurance, right? In Queensland, I'm sure it'll be a similar thing. I mean, you guys have got probably even stricter guidelines for the QBCC, but there's that, 20% is what they call low risk to your client, and then net profit 8%. So if you're showing good financials, obviously you can you can do more work. All right, now front end, let's talk about automating your sales, which is once you have your financial controls in place, is really the holy grail and the key to your success. So your marketing is selling in advance, but your sales is one of the #1 areas where you can free up a whole lot of time. And I know for most of you, time management is the biggest challenge right now, because there's never been more inquiry coming through, there's more work on, you're very short on time. So if you can automate that front end process, and a big part of that is saying no. So again, Tim Warren's a good example of this. Tim was at our event in Sydney that we had Builders Coach and Biz Video Marketing come and had an event in Homebush in Sydney, and I interviewed Tim, and he spoke about his conversion rates and the metrics. He had 200 inquiries come in that equated to 35 site visits. The 35 site visits converted into 30 contracts, and he uses prelim agreements and charges for quotes as well. So saying no is a big part of that sales process, but obviously it requires that you have enough inquiry coming in. So our best clients are actually working on their marketing now, because at some point things are going to drop off, and you want to be able to build up enough quality inquiry so that you've got that consistent flow of quality jobs coming through as well. So educating your clients is absolutely crucial. Our sales process, and again, you can get a copy of the sales process and all the documentation in our book. It's #1, qualify. So anyone who's not a good fit, especially a tie kicker, you want to get rid of them as quickly as possible in seconds. You don't want to waste 1 second of your time with someone who's not a qualified prospect. And you want to educate them as well. You want to help them understand the complexity involved in building. You want to help them understand why you would be the best choice for them. If your niche is dealing with luxury custom homes on sloping blocks, for example, and you've got a portfolio of that type of work in your area, you want to help them understand why it's a complex thing to do, but you can do it exceptionally well, and you've got the best team and processes for that. So you want to educate them, and you can do it in a leveraged way these days using video content or sending out educational PDF documents in the lead up to them meeting with you. And again, you can do that on your marketing, social media platforms and websites. So using prelims and a cost analysis, or charging for quotes. All right, if you want to know how much people charge for quotes, the best estimators charge around 2.5% or 1/4% of the contracts on $1 million project, 2.5 grand. And then, I highly recommend doing that. If you want to use the best estimators to know who they are, just email me. I'm happy to share their details with you. One of our best guys is up in Queensland, and they're obviously very busy at the moment. Okay. Mindset, guys. 70% of success, at least between 70 and 90% is mindset. You've got to see yourself as a price. One of my favorite clients I work with, this is the #1 thing that he learned. He always saw his clients as a price because he was doing big multi-million-dollar projects, and he always thought of them as being able to hand money over to any builder, but really it's the other way around. If you've got good structure and process and you can deliver well, then you are the prize. You've got to see yourself not in an arrogant way, but just see yourself as the builder who, again, if you've got good marketing, has choice. So you have choice, all right? You don't need to compromise on your values and do work with someone. One of my guys this morning, he said, Kurt, I've made a decision, no more cash, no more friends, no cash jobs, no friend jobs, and no small jobs. That's it, okay? So recognize that you've got to know what your niche is, your area of specialty, and then be prepared to do some work with your marketing so that you create your own economy of supply and demand, and there's more demand for what you do than your ability to supply. And that's exactly what your marketing does. With marketing these days, it's all about quality content. If you think of the Grayers of the world, Future Flip, young blogs that get this, they understand this, a huge leverage. You can send a video out, thousands of people can see it, people then fall in love with what you do, and by the time they come to you into your sales process, they already know, like, and trust you. Okay, so creating quality content, which I'm not saying go buy a drone and create your own quality content. You can get people to do this for you. You can get people to do it. If you can get onto TV shows as well, guys, that's a huge thing. We've got a couple of guys through the NBA that have got, it's being televised, right, in the lead up to the award. So if you can get involved in those things, as well as any other, you're going to get quality content it's well worth the money you spend if you've got to throw a bit of money at it. But you can get your suppliers and architects involved as well. You want to have at least 10 different ways to generate inquiries, to have a marketing plan. So I suppose the question is, do you have a marketing plan? And again, are you working that plan? You don't need to become a marketing specialist, guys. This is an area that even I outsource to. So we have some of the best marketing people out there for builders who we point to exactly as I would with accounting, and I'm pointing to Xact Accounting. So on that note, just really running out of time, so I want to wrap up. The number one way you can leverage in your business, okay, again, pointing to the fact that time management is the biggest challenge right now. Setting up a sales process is a great first step. The other opportunity is to leverage through people. So instead of asking yourself, how do I fix this problem? How do I get these financial controls sorted out? Ask yourself, who can help fix this problem? And obviously that's where Xact Accounting comes in. And yours truly as well. I can help share the right documents and systems with you. So make sure that you request a copy of the book. I'll send all the book resources out to you. And if any of you want to book in a time to have a chat to me about my one-on-one coaching services, you're welcome to do that as well. Just email info@builderscoach.com.au. And on that note, we will just check if there are any questions. It's going to go in there. Let's have a look. Looks like Megan saying thank you. Need to go. People have obviously run out of time. Let me see if there's anything in the other box. No. I think it's all been covered. Guys, I just want to say a big thank you to all of you who joined us on the live call. If you're watching the recording, obviously everything we've spoken about applies to you as well. Thank you to Dan and Suzanne and Phil at Xact Accounting. It's been an absolute pleasure. We'll talk to you soon. Take care.